Hi, Leslie Koo here. The US, Iran continue to launch missiles, drones, whatsoever, to attack each other. And it doesn't seem to have any indication as of now that the US will stop bombing Iran. And in fact, Trump has said that the attacks will be more and more aggressive and the intensity will be worse and worse. So as of now, I don't see there is any chance or high probability of the two countries back to the negotiation table. That means for this week, markets will continue to be cautious because of the low probability that Iran will go to UN and say that, no, okay, let's stop fighting and start talking again. There's no chance of that. And that's why I would think that market will remain cautious and that will impact the oil and gold prices this week. Now, let's look at the oil price. Well, because of the current situations, it can only get worse before it can get better. So what I mean is that the US will launch more attacks and Iran will retaliate by launching more attacks before both parties will be willing to talk again. So the upside risk, not the upside risk, the risk is biased to the upward momentum of the oil price. So this is the baseline, and the because of the risk is biased to the upside, the probability of the oil prices going up is much higher than the probability of the oil prices easing. And there is a chance that the oil price, because as of now, we don't know what the US will do and what the Iran government will do. There are reports surfacing that there is a hit list of all the people involving all the people who are involved in the Iran attacks. So all these things make the investors, oil importers, the sovereign funds, so on and so forth, very nervous, very cautious. It's just very uncertain, very fluid. That's why we will see that the oil price is more, for this week, is more likely to head up before coming off. So this is the situations for the oil price. Now look at the gold price. Like before, when the risk is biased to the upward momentum of the oil price, there is a downward pressure on the gold price because oil importers will need more US dollars. It has to prepare more US dollars in view of the upward price trend of the oil price. So it has to cater more US dollars. So one avenue to get US dollars is to sell gold because gold is priced in US dollars. So that's one. Another one factor that continue keeping the downward pressure on the gold price is the expectation that the Fed will, or not will, but can only keep the interest rates at the current level, and it is likely it will continue to do so because of the US inflation risk, that because of the current oil price situations. And making worse is the Fed may have to raise interest rates if the US inflation risk continue to escalate. So because of that, that's why there is continued downward pressure on the gold price, because holding gold gives you no interest, no dividend, but relocate the funds on gold to another US dollar assets, give you return, give you dividends. Then at this moment, I still see there is a very firm support for the gold price at $3,900 to $4,000 per ounce. At this level, I believe central banks and as well as other sovereign funds with deep pockets will start piling up on their gold portfolio. Why? That will be another video. For among the central banks, I will see that the China Central Bank will be the one that will heavily pile up its gold portfolio when the gold prices hit the $3,900 per ounce to $4,000 per ounce. Okay, this is the outlook for this week for the situations in the Middle East, the oil price and the coal price. That's all for this video. See you in the next one. Thank you for watching. Cheers.